Hey everyone, welcome back to Corporate Decoder. Today we are diving into a financial report so dense it could probably stop a bullet. Okay, maybe not, but it's definitely packed with information about the Federal Home Loan Bank of San Francisco. We are going to try and break it down without needing a financial dictionary, so let's jump in. This report is called an 8K and it's like a quick update the company sends to the Securities and Exchange Commission, basically the government's financial watchdog. The important thing is the date, April 8, 2025, which means this is pretty fresh information. It tells us about events that the company thinks investors should know about quickly. So what's this report actually about? It deals with something called a direct financial obligation, which sounds scary, but it's just a fancy way of saying debt. The Federal Home Loan Bank of San Francisco, which we'll just call the bank from now on, gets money by selling debt securities, also known as bonds and discount notes to investors. Think of it like the bank is taking out a loan from the public. These bonds and discount notes are special. They're not just the responsibility of the San Francisco Bank, but actually all 11 Federal Home Loan Banks together. That means if one bank can't pay, the others have to chip in. These banks are overseen by an agency, can even force any of these banks to pay off the debt of another one if needed. It's like having a safety net, but also a really strict parent. These bonds are sold to the public through something called the Office of Finance using big securities dealers. But here's a key thing to remember. These debts are only backed by the banks themselves and not by the US government. So it's not like a government guaranteed loan. Now let's get to the interesting part, Schedule A. This schedule lists all the bonds and discount notes that the bank plans to issue. Basically, it's a list of all the new debts the bank is taking on. We will see a snapshot of the bank's borrowing activity. Alright, so let's break down one line from Schedule A. The trade date is April 8, 2025. This is when the deal was agreed upon. Next, there's this user P number, which is 3130B5 VC9. Think of it as a social security number for the bond. It's a unique ID. The settlement date is April 10, 2025. This is when the bond is officially transferred to the buyer and the bank gets the money. Then we have the maturity date, October 14, 2025. This is when the bank has to pay back the principal or the original amount borrowed. The next pay date is July 14, 2025. This is when the bank will make an interest payment to the bondholder. The call type is non-cal, meaning the bank can't just decide to pay it off early. The call style and next call date are NCHA because it can't be called, so those don't apply. The rate type is variable single index floater. This means the interest rate on the bond can change over time based on some kind of market index. It's not a fixed rate. Finally, the bank par is $500,000. This is the face value of the bond or how much the bank borrowed. $500 million, not pocket change. The report includes some extra explanations about call types. Optional principal redemption means the bank can choose to pay back the bond early under certain conditions. There are different call styles like American, meaning it can be redeemed any time after a certain date. It also explains rate types. Fixed means the interest rate stays the same, while variable means it can change. Rate subtypes define if the rate is constant, steps up, or steps down. There are also more complicated bonds like stepped floaters, where the interest rate increases over time based on a market index, or ratchet floaters, where the interest rate can't go lower than the previous payment. The report is signed by Antonio D. Rustedy, Senior Vice President and Treasurer, which means he's the one responsible for all this borrowing. Now, let's step back and look at the bigger picture. The Federal Home Loan Bank of San Francisco is a key player in the housing market. They provide funding to local banks, who then lend that money to people to buy homes. By issuing these bonds, the bank gets the money they need to support the housing market. One of their strengths is that their debt is backed by all 11 Federal Home Loan Banks. This reduces the risk for investors and allows the bank to borrow money at lower interest rates. A potential weakness is their reliance on the housing market. If the housing market crashes, the bank could have trouble repaying its debts. Overall, the Federal Home Loan Bank of San Francisco seems to be in a fairly stable position. They are a well-regulated institution with a strong backing from the other Federal Home Loan Banks. However, investors should always be aware of the risks associated with the housing market, which are currently very volatile. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. And let me know in the comments what company report you want me to decode next.